I think we're all reflecting more upon the move over the last few weeks. And what's interesting going into this earnings season, the bar is probably reasonably low. But we all know that operating income and essentially margins are probably flat to down small. We know sequentially that EPS is supposed to come in about 4% year over year, down 7%. If you think about the banks, we actually have a lot of banks that I think are much better than their fundamentals. And I think the valuation there for that sector, as opposed to some other sectors, looks pretty interesting. I think we've gotten some green light, at least in terms of their capital return programs, buybacks and whatnot. And I think JPMorgan and Bank of America, for example, are places where I think investors can actually find valuation upside. As we look at the broader dynamic, it's everything from the Fed that was out there very vocal today and still hawkish to interest rates that aren't going to change, even though CPI Wednesday is probably going to be dovish. You named some of those big banks. Any of the regionals look attractive. I mean, they've been all over the place and volatile moves you don't normally see from those names. Any opportunity there ahead of hearing more of the details of what's going on below the surface? Well, I tell you, I look at some of the names, even a Truist or who is now at this point maybe even growing into Money Center Bank. But I think I own the KRE, and I do believe that valuations got to a place where even though it's impossible to assess the flight, essentially the capital flight in the digital world we live in, valuations are pricing in recessionary credit trends across the group. Okay. Now, Steve, what do you make of this recessionary trend idea? Some people could say maybe we're already in one. We never know.
Yeah,
until after.
I agree with that. I think that we could have already been in a recession. I think if you look at FactSet's numbers on earnings estimates for Q2, they're looking for down 7% or so. Q3, 0.8% up, troughed, and then Q4, plus 8%, 8.2%. That would be the recession probably already took place. Okay. So if that happens, maybe it was masked by the energy outperformance last year. I think that everyone is so crowded on the bear side of the trade that maybe they missed the trade going forward. And if you look at, I think their prediction for the S&P is up 9% from here. That would upset everyone's dance card, so to speak, on the portfolio side. So I think we are in for something we're not expecting, which is higher markets at the upper end of a range right now. That's interesting. Courtney, what do you make of everything that you've seen in the last couple of days and how the Fed may be putting all of that into play, plus the number that we're going to get on inflation, knowing that the market is putting, I think, something like 82% chance that the Fed does hike in July?
Yeah, which we need to see because obviously we got jobs numbers early last week, which blew expectations, and then they're actually much more muted than we thought on Friday. So you could take either side of the coin here, but I think we really need to see how those inflation numbers come in. And I think if we do continue to see inflation coming down, which we have been seeing, they're going to eventually have to follow the data, and that's really what the markets have been pricing in. But ultimately, you're still not going to see any sort of cut this year, likely. And I think that's what people need to get on board with, because people have been rushing into all of your high valuation companies. When you look at it, the S&P 500 versus the equal weight S&P 500, which is not as concentrated in just those 7 companies, trades like a 20% discount right now. And I think that's where you do want to take the idea of there's plenty of areas in the stock markets right now that can take advantage, even if we're in this higher rate environment, which we very well might be.
A lot of Fed speak so far this week, Guy, and Mester saying, look, rates are going to need to move up somewhat further, given some stubborn inflation. It looks like we're going to get another rate hike. Courtney doesn't think, of course, that we're looking at a cut anytime soon. What do you make of what's going on?
Yeah, nor do I. I'm with Courtney on that. Mary Daly, San Francisco Fed chair, president, I guess, said, the lag effect is longer than we thought. Right. A couple more hikes. I mean, that's pretty hawkish stuff. So I think there's something for everybody. In terms of the banks, I do think they're important. I'd say Tim makes a great point in valuations. And I start to look at it. Are we in an environment where they should be trading at sort of historical norms, or should you sort of ratchet it back? JPMorgan at 145, for example, is probably closing in on 2 times tangible book, maybe 1.5 times book value. That's historically not ridiculous, but in this environment, it might be a little bit. Now, the stock has traded well over the last couple of weeks, but the run-up in banks into earnings, I don't know. I mean, it looks like maybe a little too much too fast. I think the regional banks, and Tim has made this point as well, are interesting, and in the absence of bad news, which we haven't had any now for quite some time, they'll start to levitate higher. The problem, I think, is there's bad news coming.